Hello everyone, I welcome you all to Unacademy's Just CA Foundation YouTube channel. And my friends, I wish all of you a very happy and a prosperous Happy Diwali and a Happy New Year. Yes, so let's start, my friends. We, the Just CA Foundation team, are going to start with the May 2021 batch from 18th of November on our this very YouTube channel. So tell all your friends, tell all your juniors who are going to give the exam in May 2021, and we'll teach all the subjects of CA Foundation on this very much channel. Okay, so let's go now. I am Mohnish Vora. I am a chartered accountant, a commerce graduate. I've also cleared CFA level 1. And friends, I teach you the subject of business economics and business and commercial knowledge, which is the paper number 4 of your CA Foundation. And this video would be your English revision video. This video would be in the language English, and this video would be of chapter number 3, theory of production and cost, that is unit, and unit 2, theory of cost. So we have already completed the theory of production part, and now we'll complete the theory of cost part. We'll revise all of the points of all the important points of theory of cost unit. Yes, but before starting the video, I want to tell you that you have to install the Unacademy learning app from Google Play Store or App Store. Then from there you can go to the CA Foundation and Intermediate section, from where you can see the symbol of plus, and you can subscribe to Unacademy Plus. Now see, on Unacademy what happens that there are two types of classes. One are special classes, and the other type of classes are plus classes. The special classes are totally free. And every day a whole lot of faculties on Unacademy post their free special classes every day. Many live videos are going on the Unacademy app, and there is also something called as plus classes. The plus classes are fully paid classes. Yes, so if you want to study your subject, if you want to study the whole syllabus of CA Foundation and Intermediate in a more structured way, and if you want to cover the whole syllabus with Unacademy, then you need to subscribe to Unacademy Plus. Now you have an option of subscribing of different months. For example, you can subscribe for just 1 month, 3 months, 6 months, 12 months, or 24 months. Yes, the same way, for example, when you also must be watching some movies and TV series on Netflix and Amazon Prime. Yes, so you get to watch some free movies on that, and you also have to get subscription to watch the premium content on Netflix and Amazon Prime. The same way over here, we have some special classes, and special classes are also very much amazing, and we have the paid platform, that is plus classes. And for the plus classes, you have to subscribe to Unacademy Plus. You are getting the classes of foundation, 4 subjects of foundation and 8 subjects of intermediate. A total classes of 12 subjects you get in just 17,500 for 1 year, or 21,000 for 2 years. Yes, now if you want a 10% off on these amounts, so you can use my coupon code, that is MVSIR, and you would get a 10% discount on all the amounts. So see, all the amounts have now reduced reduced by 10%, and now the amount of 12 months is just 15,750, and if you subscribe for 24 months, you get the subscription in just 18,900. You also have the option of EMI. So that you can pay the fees in installments also. So for the 6 months, 12 months, and 24 months, you have the option of no cost EMI. Yes, so you can even pay the fees in installments. Okay, now I am teaching the economics chapter 4 and 5 in detail only on Unacademy Plus. So if you want to study economics chapter 4 and 5 and BCK chapter 3, 4 and 5 in detail from me, then you need to subscribe to Unacademy Plus. Okay, now we'll start with a revision of theory of cost topic of chapter number 3 of business economics. So the first thing comes is cost analysis. Yes, cost analysis. What do you mean by cost analysis? Cost analysis means the study of behavior of cost in relation to one or more production criteria. What does it mean? It means that if you change your size of output, what effect it will have on the cost of production? If you change your scale of operations, if you change your scale of production, then what effect it will have on the cost of production? If the prices of your factors of production, if the inputs which you are using, the prices of your inputs changes, what effect it will have on the cost of production? That is studied under cost analysis. Yes, So under production analysis, we were focusing on the physical aspects of production, that is how many units I will produce, and under cost analysis we focus on the financial aspects, है ना, we focus on the financial assets of production, है ना. So under production analysis we focused on physical aspects, that is number of units, and in cost analysis we focus on the financial assets, that how much amount will be incurred to produce a particular level of output. Yes, then the next concept comes is cost concepts. So you have a total of 7 points over here. First point is accounting cost and economic cost. Accounting cost includes all the explicit costs in which you actually have to pay money. Yes, the cost in which you actually have to incur some expenditure, that is called as accounting cost or explicit cost. These costs are recorded in your books of accounts. And what do you mean by economic cost? Economic cost includes explicit cost, plus they also include implicit cost. Yes, so accounting costs are only explicit costs, but under economic cost we consider explicit cost also, plus we also consider implicit cost. And what do you mean by implicit cost? The cost of using self-owned factors of production are called as implicit cost. So for example, if you own a building, yes, and you have the option of either to give this building as rent, you can give this building on rent to someone else, so you can earn rental income from a building, or if you use this building for your own business purposes, if you use this building for starting your own business, then what will happen? Now you won't be able to earn the rent, yes. So this is called as your implicit cost. The cost of using your self-owned factors are called as implicit cost. Now one more thing, if for example if you have money, yes, obviously if you have money, then you can either invest your money in bank or some other areas, and you can earn interest or earn some income from that. Or if you invest your money in business, then the money invested in business, you won't be able to invest the same money somewhere else. Now the income which you could have earned on your money, which you have now invested in the business, that income which you could have earned is called as implicit cost. That is called as the cost of using your self-owned factors in your business is called as implicit cost. The next point is outlay cost and opportunity cost. What are outlay cost? Outlay cost means again the same thing as accounting cost. Under outlay cost, you actually have to incur expenditure, so those are called as outlay cost, and outlay cost are recorded in your books of accounts. And what is opportunity cost? Opportunity cost means the cost of next best alternative foregone. So for example, if you have a building, yes, and you have the option of giving it on rent you have three people who want your building on rent. Now there are three people, A, B and C. A is offering you 50,000 per month. B is offering you 60,000 per month, and C is offering you 70,000 per month. Yes, so you will be getting 50,000, 60,000 or 70,000 if you give your building on rent to A, or you can give it to B, or you can give it to C. Yes, now obviously what will I choose? I'll choose to give my building to C. Since I'm getting more rent over here, I'll choose to give my building on rent to C. Now what will be my opportunity cost over here? My opportunity cost over here, now some people say, sir, your opportunity cost is 50,000 plus 60,000. No, your opportunity cost is the cost of the next best opportunity foregone. What is the next best opportunity? The next best opportunity was to give your building on rent to B. You could have earned 60,000 per month. So the next best alternative which you have foregone, which you have sacrificed, the cost of that is 60,000. So when you are giving your building on rent to C for 70,000 rupees, you are sacrificing the option to give your building on rent to B. So 60,000 will be your opportunity cost in this case. And again, your opportunity costs are not recorded in your books of accounts. Okay. Now The next thing comes is traceable cost and non-traceable cost. What are traceable costs? Costs which are incurred, which I can trace, for that for which exactly for which product I have incurred that cost. If I can tell that, so that is those are called as traceable cost or direct costs. Traceable cost or direct cost. So for example, if I have a shirt manufacturing factory, yes, now what will happen over there? I will obviously manufacture or produce shirts. Now I'll use cloth to make shirts. The amount which you pay for the cloth, the raw material which you are buying for making of cloth, yes, for making of shirt, the cloth which you are purchasing, you know that obviously you have purchased that cloth in order to produce a shirt. You can directly trace it, that for which type of product I am using this service, from which type of product I have bought this type of good. Yes, so this type of expense is your traceable cost or direct cost. Now what will come under non-traceable cost? Now for example, you have a building in which you are producing two goods, product A and product B. Yes, you are producing two goods, product A and product B. Now you have just one single gate. Of this factory, and here you have kept two watchmen. Yes. Now tell me exactly that these two watchmen are for which type of product? Are they for product A or are they for product B? Obviously we cannot trace it exactly, that how much salary I am giving for product A and how much salary I am giving for product B. So this is a type of general expenditure that will come under non-traceable cost or indirect cost. One more example. See, since if the building's electricity expense comes under just one bill. Yes, if you get electricity expense, for electricity you just get one. If you are getting just one bill from the electricity department for your whole factory in which you are producing two goods, now how will you bifurcate that in your electricity bill? How much have you used for product A and how much have you used for product B? You cannot bifurcate. So over here I am not able to trace that exactly for which type of product how much expenditure I have incurred. So in this case your electricity expense will also become non-traceable cost or your general expense or your indirect cost. Okay, now next is incremental cost and sunk cost. If I am taking a decision, the cost which I will have to incur if I am opting for a particular decision, that cost will be called as incremental cost. And next is sunk cost, the cost which I have already incurred in the past, and now even if I take any decision or if I don't take any decision, that money is not going to come back to me. That the money which I've already paid in the past, that money is not going to come back to me. So those type of cost come under your sunk cost. Yes, so the cost which you have already incurred, in the past, which you are not getting back. If you take any decision or you don't take any decision, that amount is not going to come back to you. Those type of costs are called as sunk costs. Then the next is historical cost. When you buy a product, the price at which you have bought the product. Yes, the price at which you have buy not a product. I'll take an asset. For example, if you're buying an asset, yes, for your business, if you're buying an asset for your business, the amount at which you have bought that asset is called as historical cost. Yes, you record your assets on historical cost itself in your books of accounts. And my friends, the next is replacement cost. If the asset which you have produced, if the asset which you have earlier purchased, if you want a same new asset from the market at that point of time, then what will be the cost of buying a new asset, same new asset from the market? That would come under your replacement cost. Then there is something as private cost and social cost. Private costs are all the costs which a firm incurs for itself. Are called as private cost. And social costs are costs which are to be borne, by the whole society. So now if you want to go from your office to your shop, if you want to go to your factory or shop from your home, so you go through by road, you go by road. Yes, whether you have built that road, whether you have given the money, given the whole money to build that road, no, that road is built by public's money. Yes, So all the costs which are incurred by the society on behalf of you, which are borne by the whole society as a whole, that those come under social cost. Now if you are running a factory, and because of that factory there is air pollution, now because of the air pollution also, society also needs to pay cost for that air pollution. Yes, because of air pollution the whole society gets hampered due to that. Yes, so those costs would come under social cost. Then comes fixed cost and variable cost. What is a fixed cost? Costs which do not change with change in output. Costs which do not change with change in output are called as fixed cost, and costs which change with the change in output are called as variable cost. So if you increase your output, your variable cost increases. If you decrease your output, your variable cost decreases. What are fixed costs? Fixed costs are, even if you increase your output or decrease your output, you will have to pay a fixed amount for that. Those are called as fixed cost. Okay. Now next is cost function. What is a cost? I have told you that what is a function. Function is a mathematical expression which tells you the relationship between independent variable and dependent variable. Yes, so here the dependent variable would be your unit cost or the total cost of production, and the independent variable would be that the inputs which you are using. What is the prices of the inputs which you are using? Yes, so please understand, your total cost of production depends on the prices of the factors of production. The size of your plant, if your plant size is big, then your cost will be more. If your plant size is small, your cost will be less. Yes, so your cost of production depends on the prices of the inputs, the size of the outputs. Yes, then what technology you are using, what are the level of capacity utilization, efficiency, time period, all these things are independent variable. And what is the dependent variable? Your total cost is dependent on all these variables. Yes, so this is a cost function which would express the relationship between dependent and independent variable. Yes, so you can write like this, that the total cost of production would be a function of the prices of factors of production, the size of output, the technology which you are using, the level of capacity utilization, the time period in which you are producing. Yes, all these things would be your independent variable. So your cost is dependent on these factors. Yes, so cost is a function of all these factors. So this is your cost function. Now again, cost function is a function which is obtained from production function. See, this is very important point, that cost function is obtained from production function. In production function you were telling that for producing your units, for producing your output, which inputs are you using, and if you know that which inputs you are using, only then you will able to know that what are the prices of those inputs. So using the production function, you get cost function. Are you getting my point? Yes. So see, so cost function is obtained from the production function. So from the production function you will get to know that which inputs am I using and the market supply of inputs, and from the market supply of inputs you will get to know that the inputs which you are using, what is the current price of those inputs in the market. Yes, so the cost function expresses the relationship between cost and your output. Now cost functions, next, cost functions are derived from actual cost data and are presented through cost curves. Yes, so see, this is very important point. The shape of cost curve depends upon the cost function. I have also asked this as MCQ I have made an MCQ on this, that the shape of cost curves depends on your cost function. Yes, now next is cost function are of two kinds, short run cost and long run cost. So let's first focus on variable factor and variable cost. Variable factors are those factors which can be easily varied with the change in the level of output. If you are changing your level of output, then the factors of production which you can vary easily. So for example, your casual laborers, your raw material, yes, so you can vary these easily with the change in output. So these would come under variable cost. And variable costs are those costs which change with the change in output. These are called as variable costs. So that's why you say that a variable cost is a function of output. Variable cost is a function of output. Okay, because if the output is changing, the cost will also change. So this can also come as an MCQ. Then what are the variable costs? For example, wages paid to casual labor, prices of raw material, fuel, power used, transportation cost, all these would come under variable cost. Then if the firm shut down for a short period, if you shut down your business for short period, then what will happen? You would not require to use the variable factors. And if you are not using the variable factor, then obviously you won't be requiring to pay the cost also. Yes. So if you shut down your firm for short period, what will happen? You do not require to incur variable cost. Then variable cost curve, here the variable cost curve which is made, it is drawn under the assumption that variable costs change linearly with the changes in output. What do you mean by linear relationship? Here actually they have assumed that there is linear relation. What do you mean by linear relation? That if you will double your output, your total variable cost will also double. If you triple your output, your variable cost will also triple. If you increase your output by 4 times, then even your variable cost will increase by 4 times. So, sir, does this happen every time? No. Here, while making this graph, they have assumed over here. It doesn't happen always. It can happen, it cannot happen. Yes, but what I'm telling you, see, if you increase your output, your variable cost will increase. Definitely it will increase, but it is not necessary that it will increase linearly, that if you are doubling your output, exactly double, your variable cost will double. It doesn't happen always. Here they have taken an assumption that if it happens that the relationship between both of them is linear, only then what will happen? This kind of variable cost curve you get exactly 45. So here it is 45 degree, exactly from the middle, so it is upward sloping curve, variable cost curve. Okay, always your variable cost curve is upward sloping, but it may happen that it can be like this, 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 it can be of any type. But over here we have assumed that it is linear relationship, and that is why it is from the exactly like this. Okay, next is fixed factor and fixed cost. The factors which cannot be easily varied. For example, building, you cannot keep on buying building in just within a week or within a 2 weeks time. You cannot just increase your building number of buildings and decrease your number of buildings in less time. Then capital equipments, that is machinery, or top management team. So which are the top management team? The CEO, the managing directors. CEO is chief executive officer, the chief financial officers. All these people are very key people of your, these are called as the key management personnel, KMP, key management personnel of your company. So it is, see, if you want to hire new CEO, then it takes a lot of time. It is a very big decision, because the type of CEO, MD and CFO your company has, your company's future is dependent on the type of people you hire. So obviously it is a very big decision when you change your CEO or you change your CFO. Okay, when you change your CFO, so it takes a lot of time in order to change them. Okay, so here see, here have a look. So see, such factors which cannot be readily varied require a longer period to adjust. See, they require a longer period to adjust. What do you mean by longer period? They require a longer period in order to change their quantity, or in order to change them totally. You require a longer period. So those come under fixed factors. And what are fixed costs? Fixed costs are those costs which are independent of output. They do not change with the changes in output. Yes, but one important thing, for example, if you have a factory in which the capacity of your factory is, for example, that you can produce 10,000 units in this factory. You can produce 10,000 units in this factory, and the rent of this factory is, for example, 15,000. Now, if you produce 2,000 units, if you produce only 2,000 units in this factory, even then you will have to pay rent of 15,000. If you produce 3,000 units of your product in this factory, then also you will have to pay 15,000 itself rent. If you produce 8,000 units of output in your factory, then also you will have to pay 15,000. Then what is happening, sir? What is happening? If you are changing your output, still your fixed cost is remaining same. But if you change your capacity, for example, if you want to produce 15,000 units, now your factory, the capacity of your factory is only 10,000. The capacity of factory is only 10,000. If you want to produce 15,000, then you would need an additional factory, or you would need a bigger factory where the capacity would be 15,000, or you would need an additional factory where the capacity of that factory would be at least 5,000. Are you getting my point? Now for this factory, again for the next factory, you will have to pay, we will have to pay rent separately. So now your fixed cost is increasing. So please understand, when your capacity changes, your fixed cost changes, but when your output changes, at that point your fixed cost doesn't change, है ना? So that is why what we say is that fixed cost is a function of capacity, but our variable cost is a function of output. Are you getting my point or not? Please tell me, है ना? Please tell me in the comment section. Okay, now so see, again, now even if the firm closes down for some time, still but remains the business, still they will have to bond the fixed cost, they will have to pay the fixed cost. Now if you have a factory whose rent is 15,000, if you are shutting down your factory for 15 days, for example, for 15 days, है ना? or take an example of our corona. In our corona, we had a lockdown of 20, actually we have a lockdown for a longer period. For example, the first 21 days we had a lockdown, है ना? In case of corona. So in these 21 days, if you have shut down your factory, still you will have to pay rent. But when you had shut down your factory, at that point you wouldn't need to pay any variable cost, because you are not using any variable factor. But even if you shut down your business, still you would need to pay your rent, है ना? So what is important, rent means fixed cost over here, है ना? Rent is a fixed cost. So what do you mean over here? That if you close your firm, if you shut down your firm, but remaining in business, see, you are not closing down your business, you are not closing down your business, you are just shutting down your business for some time. There's a difference between shut down and closing your business. Yes, so if you are shutting down your business for some time and you are remaining in the business by shutting it down for some time, at that point of time you will still have to incur your fixed cost. So what are the examples over here? Contractual rent, insurance fees, property taxes, manager's salary, interest on capital employed, and watchman's wages. All those things would come under fixed cost. Now have a look what is happening. See, even if, for example, your fixed cost is 15,000, even if you produce 0 units, still you will have to pay 15,000. If you produce more than 0 units, still you will have to pay 15,000 itself. So whatever be the amount of output, your fixed cost will remain constant. So that is why your fixed cost curve is a horizontal curve over here. Okay, now next, short run versus long run. What do you mean by short run? See, the difference between short run and long run is that, see, in short run, if you want to increase your output, see, if you want to increase your output, if you want to increase your output, so in the short run you can vary only the variable factors in order to increase or decrease, है ना? In order to increase or decrease your output, in the short run you can vary only your variable factors, you cannot vary your fixed factors, है ना? Because it is short run. And but in the long run, what happens? In the long run, please have attention, please pay attention. In the long run, all factors become variable. See, all factors become variable. So over here all factors are variable, so I can vary all factors over here. Please understand, in short run itself, I can have a distinction of variable factor and fixed factor. In the short run itself, I can have a distinction of variable factor and fixed factor, but in the long run all this input become variable, and in the long run, in order to increase or decrease our output, you can vary all the factors of production. This is the main difference between short run and long run. Okay, now what is semi-variable cost? Semi-variable cost is that with a cost which is not fully fixed, a cost which is not fully variable, that is called as semi-variable cost. Okay, now so see, neither perfectly variable nor absolutely fixed. Now in case of electricity expense or in case of postpaid telephone bill, what happens in case of postpaid telephone bill? they tell you that, see, every month, in case of postpaid, I'm talking about postpaid telephone bill, they'll give you that, for example, in rupees 500, you will get a talk time of 10,000 minutes per month, and you will get, for example, 100 messages per day, है ना. So this is the type of plan which they give you in your postpaid telephone bill. Now, even if you talk for just 2000 minutes, in a month, still they'll charge you 500. If you talk for 5000 minutes in a month, still they'll charge you 500 rupees. If you talk for 8000 minutes, still they will charge you 500 rupees. But if you talk for more than 10,000 minutes, then the more you talk on your phone, the more talk time which you use, your bill will start increasing. What does this mean? That semi-variable cost is fixed up to a certain level. And after that, if you increase your usage after that, then your cost will start increasing. So that is why for up to a certain level of output, your cost remains fixed. But after you increase your usage, your cost will start increasing. So your semi-variable cost is like this. So what are the example? Electricity charges. In electricity also, I have a shop in Nagpur. And I am not using that shop since I guess 5 to 6 years. But still, every month I get an electricity bill of rupees 400. I am not using anything. In that shop. Still, I am getting a bill of 400 rupees. Why? Because that is the minimum cost which you will have to pay. So in case of electricity charges also, up to 400 rupees. This is an example. Please don't take. This is an example. Up to 400 rupees. What is happening? I'll have, even if I use or don't use, I'll have to pay 400. But if I start using electricity over there, then my bill would increase. So this would be a case of semi-variable cost. Then comes, my friends, stair-step variable cost. Yes, what happens over here? That up to a certain level, your cost remains fixed. Then it increases. Then up to a certain level of output, your cost remains constant. Then it increases. Up to a certain level of output, again it remains constant, and then it increases. So see, here your cost increases in a stair-step fashion. They remain fixed over certain range of output, but suddenly jump to new high level when output goes beyond a limit. And for this, I had given a very interesting example of box and chocolate in my regular lectures. So for timing, you just remember this first line. Okay. Next is short run total cost. What happens? See, in short run itself, I can have the distinction of variable cost and fixed cost. In the long run, I cannot have such distinction. In the short run itself, I can have the distinction between fixed cost and variable cost. So that is why in short run total cost, we learn that total cost is total fixed cost plus total variable cost. Total fixed cost plus total variable cost. Your total fixed cost curve is horizontal straight line parallel to x-axis, and it starts from a point on y-axis. Why it starts from a point on y-axis? Because, my friends, even when your output is 0, you will still have to incur some cost. So that is why your total fixed cost curve is horizontal to x-axis, and it starts from a point on y-axis. Then your total variable cost initially increases at a decreasing rate and then at an increasing rate. Why? Due to law of variable proportion. So as you know that in the short run, the law of variable proportion functions. So what happens over here? That initially when you are in the stage of increasing returns, your variable cost increases but at a decreasing rate. It increases but at a decreasing rate. Then you in the second stage is stage of diminishing returns. So when you move on to the stage of diminishing returns, what happens over here? Here your variable cost will increase, but your variable cost will increase with an increasing rate. So that is why, my friends, first your variable cost curve is increasing but at a slow pace. It is increasing at a slow pace, and then it takes more pace. Then what is happening? It is increasing by increasing rate. So that is why we get an inverted S shape. So see, S is like this, we write S like this, and over here what is happening, see this type of shape we are getting a shape like this. So that is why we call this as inverted S shape. We call this as inverted S shape. Okay. Now next, total cost curve. What is total cost? Total cost is total fixed cost plus total variable cost. Now what is happening? Your even at 0 units, what will happen? You will still have to incur total fixed cost, but your total variable cost will be 0 at 0 units. So what will happen? Your total cost at 0 units will be total fixed cost plus total variable cost. Now your total variable cost is 0. So what is happening? That at 0 units, your total cost will be equal to total fixed cost. So that is why from the point on the y-axis from where the total fixed cost has started, from the same point, your total cost curve also starts. So see, it is obtained by adding vertically total fixed cost and total variable cost. The slopes of total cost and total variable cost are the same. So when your cost is increasing, see when your cost, when at 0 units you would have some total cost, then at 1 unit, 2 unit, 3 unit, why your cost will increase? See, when at 0 units your total cost is equal to total fixed cost, but now when you are increasing your output, your cost will start increasing. Why will it increase? Because your total variable cost is increasing. Because when I increase my output, only my total variable cost will change, total fixed cost will not change. So what will happen? My total variable, because of total variable cost, what is happening? My total cost is increasing. So that is why the shape of total cost curve is same as total variable cost curve, but the starting point of total cost curve is derived from the total fixed cost curve. Yes, so my total cost curve also first increases at a decreasing rate, and then it increases at an increasing rate. Okay, and the difference between your total cost curve and your total variable cost curve is equal to the total fixed cost. So this can also come as an MCQ. Next is shortened average cost curve. Now, how will you get shortened average cost curve? Just divide these costs by Q. So when you divide total cost by Q, you divide total fixed cost by Q, you divide total variable cost by Q. What do you get? You will get average total cost will be average fixed cost plus average variable cost. So see, these are the shortened average cost curve. That average total cost is equal to average fixed cost plus average variable cost. Are you getting my point? Please tell me. Are you getting my point? And this is the diagram, the graph of your average shortened average cost curves. Okay. Now, what is average fixed cost curve? Simply, it is average fixed cost is total fixed cost divided by Q. That how much fixed cost is incurred for per unit. The total fixed cost divided by the number of units of output produced. That is fixed cost per unit of output. Average fixed cost is fixed cost per unit of output. Yes. So see, my fixed cost remains the same. My total fixed cost remains the same at every level of output, but my level of output will keep on increasing. Now I am dividing the same number. For example, if my fixed cost is 15,000, I will divide the same number by increasing numbers. For example, for my first unit of output, I will divide 15,000 by 1. Then for my second unit, I divide 15,000 by 2 for calculating average fixed cost. So average fixed cost at 1 will be 15,000. Average fixed cost at 2 will be 7,500. And what will happen? The denominator will keep on increasing with the level of output. So what will happen? My average fixed cost will keep on decreasing. See, my average fixed cost will keep on decreasing because my numerator is the same, but the denominator is going on increasing. So that is why my average fixed cost curve is downward sloping curve. It is downward sloping curve. Next is, my friends, average variable cost curve. Next is average variable cost curve. So what happens under average variable cost curve? See, average variable cost curve is found out by dividing the total variable cost by the number of units of output produced. That is, average variable cost will be equal to total variable cost upon Q. Simple. So see, average variable cost curve normally falls as the output increases from 0 to normal capacity due to the occurrence of increasing returns to variable factor. So when you are in the short run, when you are producing in the stage 1 of your law of variable proportion, when you are producing in the stage 1, that is stage of increasing returns, during the stage of increasing returns, your average variable cost curve decreases. In the stage when your average variable cost curve decreases, and then when you move on to stage 2 and stage 3, your average variable cost curve start increasing. Your average variable cost curve starts increasing. Okay, so this happens because of law of variable proportion. Then, so see, up to normal capacity, what is happening? My average variable cost curve will decrease, and beyond normal capacity, my average variable cost curve will start increasing. है ना? So at what point you get normal capacity? Yes. So when the stage 1 ends, you get normal capacity when the stage 1 is ending, and after the stage 1, what will happen? Your stage of decreasing returns start. And at that point of time, your average variable cost curve will start increasing, है ना? It will start increasing. Okay, so average variable cost curve first falls, then reaches a minimum, and then rises. Then next is, my friends, average total cost. Next is average total cost. How will I get average total cost? Average total cost is average fixed cost plus average variable cost, and average fixed cost plus average variable cost. Or I can also calculate it like average total cost is total cost upon Q, है ना? So see, again, what will happen for with average total cost curve? See, your average total cost curve is a U-shaped curve. It is a U-shaped curve. See, even your ABC is a U-shaped curve. Even your MC, marginal cost curve, is a U-shaped curve. Kind of U-shaped curve. But your average fixed cost curve is not U-shaped. This is not U-shaped. Okay. So this also comes as an MCQ, that which of the curve is not a U-shaped curve. So average fixed cost is not a U-shaped curve. Now see, up to this level. See, up to this level. See what is happening. Up to this level, please have a look. Here, your average fixed cost is also decreasing. Your average variable cost is also decreasing. Both of them are decreasing. And by adding average fixed cost and average variable cost itself, you get average total cost. So your average total cost is also decreasing over here. Now what is happening? Have a look. Now what is happening? That up to this point, up to this point, what is happening? See, up to this point. Now up to this point, see what is happening. Okay, up to this point. Now see. Now up to this point, what is happening? See, here also your average total cost is decreasing. Here also average total cost is decreasing. But your average variable cost has started increasing. Your average total variable cost has started increasing, but your average fixed cost is decreasing. So over here, what is happening? Over here, why your average total cost is still decreasing? Because in this period, in these outputs, what happens is, over here, the fall in average fixed cost is greater than the rise in average variable cost. See, your average variable cost has started decreasing, but the fall in average variable cost is more than the rise in average variable cost. That is why your average total cost is still decreasing. But after this point, now see, have a look at this point. Now have a look at this point. Now see, now your average total cost curve has started increasing. But over here, your average fixed cost is decreasing and average variable cost is increasing. Now what is happening over here? Over here, why your average total cost has started increasing? Because over here, what is happening? Because over here, the rise in average variable cost. Now the rise in average variable cost curve is greater than the fall in average fixed cost curve. And since the rise is more, it pulls the average total cost curve upwards. Over here the fall was more. That is why it was pushing the average total cost curve downwards. But over here, what is happening? Here the rise is more. That is why it is pulling the average total cost curve upwards. Yes. So this is the explanation of average total cost curve shape. And one more thing. Your marginal cost curve intersects your average total cost curve and average variable cost curve at their minimum points. So when your average total cost is minimum, what happens? Your average total cost is equal to marginal cost. When when your average variable cost is minimum, your average variable cost is equal to marginal cost. So this can come as an MCQ. Very important, very important. Next. So see, next is marginal cost curve. What do you mean by marginal cost curve? The addition made to the total cost. The addition made to the total cost by production of an additional unit of output. So if you produce one additional unit, what change in your total cost you will have? That is called as marginal cost. What will be the increase in your total cost? If you produced one additional unit of output? So what is the formula? Then marginal cost at n is equal to total cost at n minus total cost at n minus 1. Okay, or you can also use the formula that marginal cost is equal to change in total cost divided by change in output. Okay, change in output. Yes, next. So now see, marginal cost is independent of fixed cost. Sir, why? See, please understand. When I am increasing my output, by an additional unit, what will happen? When I am increasing my output by an additional unit, what will happen? My variable cost will increase, but my fixed cost will not increase. My variable cost will increase, but my fixed cost will remain same. So by additional unit, I am getting some marginal cost. See, marginal cost is not equal to variable cost. Please understand, marginal cost is not equal to total cost. Marginal cost is the increase in cost due to one additional unit of output. Okay, and variable cost is different. The payments which you make to variable factors of production, that comes under variable cost. Okay, but the changes in marginal cost are because of variable cost. So because variable cost changes due to change in output, that is why you get marginal cost. Yes, so see, it is only the variable cost which change with the change in level of output, and therefore marginal cost is due to the changes in variable cost. Here it is not written that marginal cost is equal to variable cost. What is they saying? That because the variable cost changes, because of that itself you get some marginal cost. Yes, so your marginal cost curve is U-shaped, and first your marginal cost curve decreases, and then your marginal cost curve comes at a minimum, and then your marginal cost curve increases. Okay, yes, next. Now see. So a marginal cost curve is also U-shaped. Now see over here, the relationship between average cost and marginal cost. So what is it? This is just an observation. So by looking at the graph, you can observe a relationship between your average cost and marginal cost. When your average cost is falling, what happens? Your marginal cost is less than average cost. When your average cost is rising, what happens? Your marginal cost will be more than your average cost. And when your average cost is minimum, what will happen? Your marginal cost will be equal to average cost. Okay, so see, when your average cost is falling, your marginal cost is less than average cost. See, marginal cost is below the average cost curve. So when your average cost curve is falling, your marginal cost is less than average cost. Then when your average cost is rising, what is happening over here? Your marginal cost is above the average total cost curve. So here your marginal cost will be more than average cost or average total cost curve. And my friends, the last point is when your average cost curve is minimum, what will happen over here? Your marginal cost will be equal to the average cost curve. So at the minimum point of an average cost curve or average total cost curve, your marginal cost intersects your average cost curve at the minimum of the average cost curve of the average cost. Yes. And one more thing, your marginal cost curve also intersects the average variable cost curve at the minimum point of average variable cost curve. Okay, which I've already told you. So here we have just a table that here we have total fixed cost which remains the same with the level of output, and then total variable cost curve which keeps on increasing as you increase your level of output. Yes, then what is total cost? Total fixed cost plus total variable cost, you will get total cost. Then what is average fixed cost? Average fixed cost is total fixed cost divided by number of units, you will get average fixed cost. What is average variable cost? you will divide total variable cost by units of output, you will get average variable cost. Then there is something called as average total cost. What is average total cost? Total cost divided by number of units of output, you will get average total cost. And what is marginal cost? Now see, what is marginal cost? By producing one additional unit of output, what is the change in your total cost? So see, due to this one additional unit of output, the change in total cost is of 40. So that is why here your marginal cost is 40. Are you getting my point? So see, your marginal cost is 40, but your variable cost is 90. So please do not say that marginal cost is equal to variable cost. And it is not like that. Okay. But you can also see over here that see, actually when you are increasing your output, your only your total variable cost changes, and because your total variable cost changes, that is why only your total cost changes. So see, even the change in total variable cost is 40. So that is why I can say that marginal cost at n is total cost at n minus total cost at n minus 1, or marginal cost at n is total variable cost at n minus total variable cost at n minus 1. Are you getting my point? We can do it again. Now see over here, I have increased from 1 unit, from 4 units I am going to 5 units. I am producing 5 units. For producing 4 units, I am having a total cost of 1196, and for producing 5 units I am having a total cost of 1255. What is the increase in the cost? The increase in the cost is of 59 rupees, and that is why my marginal cost at 5 units is 59 rupees. Are you getting my point? And even the increase in my total variable cost is of exact 59 rupees. So you can even calculate marginal cost using variable cost data, or you can also calculate marginal cost using the total cost data. Okay. Next is long run average cost curve. Next point is long run average cost curve. Now when I go to long run, when I am in long run, I don't say that long run I have, see, you will never read long run variable cost and long run fixed cost. Have you read something like this? No, because in long run all factors have become variable all factors have become variable. So why variable and fixed? Everything is all factors are same now. All factors are of same type. Yes, see in long run I can vary all the factors so there is no distinction between variable and fixed. There are no fixed factors in long run. So that is why here I only study about long run average cost. I don't study about long run variable cost and long run fixed cost. I have only long run average cost. Are you getting my point? Yes. Now see, long run is a period. Long run is a period in which firm can vary all its inputs. Very important. Now see, very important point. See, what an entrepreneur, what a businessman does is, a businessman plans that how much machinery he wants in the long run, how much should be his plant size, how much material he should use, how much labor he should appoint. He does all this in the long run. So in the long run, a businessman, what can he do? He can build any size or scale of plant, and therefore he can move from one plant size to another plant size in the long run. It will depend on the entrepreneur that whether he wants to increase his plant size or whether he wants to decrease his plant size. Are you getting my point or not? See, so that is why the long run is also called as planning horizon, because the firm plans ahead to build the most appropriate scale of plant to produce the future level of output. So first the entrepreneur, the businessman thinks that what level of output I want to produce, and according to the level of output which I want to produce, what should be the plant size for it. So I do this in the long run, and once I build my plant, once I build my factory, after that when I actually do the production, I do actual production in the short run. Because see for example, now see, I'll give you an example. I have decided that I want to produce 1 lakh units, and for producing 1 lakh units I would require a plant size of for example, I would require a plant size of 3000 square feet. I'm just taking an example that I would require a factory of 3000 square feet if I want to produce 1 lakh units of my product. Okay, and I would require, for example, 100 machines. I would require 100 machines. I'm just taking an example. So now I do this planning in the long run. And I build a plant, a factory using this. Now tell me, when the time comes of actual production, now can you again change your machine? Kya? You can change your machine, but what do you think? Arey yaar, abhi to you just build your plant, and then you have started the production, and now you'll change your number of machines. Now you'll change your size of plant. No. So what happens? The planning is done in the long run. The planning of your production is done in the long run. In the long run, you opt a particular plant size, and then when you actually do production, you do actual production in the short run. Because in the short run, you cannot vary all the factors of production. You just can vary your variable factors. Are you getting my point or not? Yes. So see, the long run, it should keep in mind that once the firm has built a particular scale of plant, the production takes place in the short run. Are you getting my point? The production takes place in the short run. Yes, this is very important. So see, briefly put, the firm actually operates in the short run, but it plans in the long run. So first I do planning in the long run, and then actual operation is done in the short run. So long run cost of production is the least possible cost of producing at any given level of output when all individual factors are variable. A long run cost curve depicts the relationship between output and the long run cost of production. So see, now how will I draw a long run average cost curve? So in order to understand that, we have taken here three short run average cost curves. Okay, now see my short run average cost curves are also called as plant curves. So see, please understand, in order to understand how the long run average cost curve is derived, we consider three short run average cost curves. These short run average cost curves are also called as the plant curves. Very important MCQ. Yes. So what is a planning curve? A planning curve is long run average cost curve. But what is a plant curve? Plant curve is short run average cost curve. Why do we call it as a plant curve? Because in the long run I choose that which size of plant I want, and the actual production is done in a particular plant size. So when actual production is done, I anchor short run average cost curve. I do actual production in short run, but I choose my plant in the long run. So my short run average cost curve are also called as plant curves. So here we have taken just three short run average cost curves over here in order to understand that. For example, if you choose that I want to produce an output of OA units, if you say that I want to produce an output of OA units, now your OA units can be produced on short run average cost curve 1. They can also be produced on a plant size of short run, which gives a short run average cost curve 2. So see, if you want to produce your OA level of units, you can either produce it on short run average cost curve 1, or you can either produce it on short run average cost curve 2. But see, if you are producing OA level of units on short run average cost curve 1, you are incurring a cost up to here. But if you produce your OA level of units on short run average cost curve 2, then see what is happening. Your cost is more over here. So what will you choose? Arey bhaiya, I'll choose to produce my output on SAC1. I'll choose my SAC1 if I want to produce up to OA. Then up to OB. Now see, up to OB. So up to OB level of output, I'll always choose to produce on SAC1. Sir, why? Because on SAC1 here my cost is less. As compared to SAC2. So that is why I'll choose to produce on SAC1. Then if I want to produce more than OB but less than OD. If I want to produce more than OB but less than OD. So see what is happening over here. I want to produce over here. If I want to have production over here, then what I'll do, I'll always choose to produce on the SAC2. Sir, why SAC2? See, here also you have the option. For example, if I want to produce OC units, if I want to use produce OC units, either you can produce this on SAC2 or you can produce this on SAC1. If you are producing this at SAC2, you are getting a cost up to here. But if you produce the same level of output on SAC1, what is happening? Your cost is increasing. Here you are getting more cost. So what I'll do, see, up to OB, I'll prefer to produce on SAC1. Then from OB to OD, I'll prefer to produce on SAC2. And similarly, if I want to produce more than OD, then I'll choose to produce in SAC3. So this is how I choose my plant size, they are saying. And once I have chosen my plant size, then I'll start production in that plants. Then I start production in my plant. Yes. So here, but what happens in real life? In real life, there can be multiple infinite number of plants. If I increase my one machine, if I increase my plant by just one machine, my short-term average cost curve will be different. If I just change some of the things, my new short-term average cost curve will be there. So what happens that in real life there can be multiple possible short-term average cost curves. There can be multiple plants. There can be multiple plant sizes now which I want. There can be a plant size of 3000 square feet. There can be a plant size of 3001 square feet. There can be a plant size of 3002 square feet, and so on. So there can be multiple possible plant sizes. There can be multiple possible number of machines. I can have 100 machines, I can have 101 machines, I can have 102 machines, and so on. I can even have 99 machines, 98 machines, 97 machines. There can be infinite number of possibilities of plant sizes. So in reality, actually there are infinite number of plant sizes. So actually the curve, the short-term average, the plant curves look like this. Look like this. But if I draw the plant curves like this, if I draw so many plant curves together, there would be very much guchud puchud. What is this called? Guchud puchud. See, you are not able to see everything clearly. So that is why what they say, that is what they did. They just draw 7. They just draw 7 curves. They just drew 7 SAC curve. Why did they do only 7 SACs? Because in reality there are infinite. But in order to explain you more clearly, they have drawn only 7 over here. Are you getting my point? What I am telling you? Yes. So now what happens? Now according to my output, I'll choose my plant. How will I choose my plant size? I just studied that in my previous slide. Now your long run average cost curve is a curve which is tangent to all the short run average cost curves. So that is why we also call this curve as envelope curve. This is pronounced as envelope and not envelope. It is called as envelope. So envelope curve. It is also called as envelope curve. Why? Because it is enveloping all the short-term average cost curves. That is why my long-run average cost curve is also called as envelope curve, or it is also called as boat curve. Sir, why boat curve? Because the shape of long-run average cost curve is like a boat. That is why it is also called as boat curve. Now see what is happening. Now see some very important point. See, when your long run average cost curve is decreasing, your long run average cost curve is tangent to the short run average cost curves at their falling portions. So what do you mean by at their falling portions? Now please understand. See, please understand that one plant size is always optimum for. See, if I am saying that this is my plant, this is my short-term average cost curve. For example, this is my short-term average cost curve, and it is also called as a plant curve. This plant curve is optimal for only one level of output. So what do you mean by optimal? That is that one plant size gives you optimum production for only one level of output. Yes, see on this cost curve you can produce many level of outputs. On this cost curves you can produce many level of outputs, but what is happening over here? See, if you produce this level of output, then you can produce this level of output, then you can even produce this level of output, you can produce this level of output, you can produce this level of output. But see what is happening here, we take cost, and on the x-axis we take output. Now see what is happening over here. Okay, have a look. On my one plant size, I can produce multiple level of output, but the optimum level would be where the SAC is minimum, where the SAC is minimum. So actually this is the optimum level of output for this particular plant size. Now see, no sir, but I want to produce less. Sir, I want to produce less. Now see, when you are producing less, your cost is coming more. See, your cost is more when you are producing less. Your cost is more when you are producing less. But if you are producing the optimum level of output for that plant size, your cost will be less. The cost will be lowest over there. So at the lowest point of our SSE, you get the optimum level of output for that plant size. So the falling portions of your SAC curve, they show that if you are producing on the falling portions of your short-term average cost curve, they are showing that, see, you can increase your production, but you are underutilizing your plant size. See, if you're producing over this point or on this point, you can increase your production and decrease your cost, but you are underutilizing your capacity, you are underutilizing your plant. That is why the cost is more. And if you are producing over here, what is happening over here? You are overutilizing your curve, or I can say that you are using your plant beyond capacity. And since you are using your plant beyond capacity, again your cost is more. So see over here what is happening. Now see over here what is happening. When my long run average cost curve is falling, it is tangent to the falling portions. Of short run average cost curve. What does it mean? That if I produce over here, what will happen? I will underutilize my plant. I can increase my production and decrease my cost, but I am underutilizing my plant if I choose to produce over here. Then if I choose to produce over here, what will happen? Here my long run average cost curve is tangent to the short run average cost curve on the rising portions. So see, these are the rising portions of the long run average, short run average cost curves. And when I am producing on the long run average cost curve, when I am producing on the rising portion of the short run average cost curve, what does it mean? That here, if I choose to produce over here, what will happen? I'll use my factory beyond capacity. So if I'm using my factory beyond capacity, again my cost will be more. If I'm using my factory if I'm underutilizing my factory, or I am using my factory less than its full capacity, then what will happen? Again my cost will be more. So that is why I always choose to produce. I should always choose to produce at the minimum point of long run average cost curve. The minimum point of long run average cost curve corresponds to the minimum point of a particular type of short run average cost curve, and at this point you get the optimum capacity of production. So when you are at the point of the lowest, at the minimum point of long run average cost curve, you get the optimum capacity of your production, the optimum level of output where you should produce, where your cost will be lowest. Yes, that is called as your optimum output. So over here OQ is the optimum amount of quantity. So see over here that that my friends, have a look, that OQ is the optimum output over there. Yes, and we also call long run average cost curve as the planning curve. It is also called as long run average cost curve as the planning curve, because a firm plans to produce any output in the long run by choosing a plant on the LSC curve corresponding to the given output at the least possible cost. Okay, chaliye. Now why the shape of long run average cost curve is U shaped. Now the reason of this, now the actual reason of this is the law of returns to scale. Now the problem in your book is, the problem in your ICS study material is that my friends, in your book they have taught you what is returns to scale, but in your book they have not taught you that what is law of returns to scale. They have just told you in the book that there is something called as increasing returns to scale, there is something called as constant returns to scale, and there is something called as decreasing returns to scale, but they have not explained you the law of returns to scale. Now I'll tell you the law of returns to scale. The law of returns to scale states that when you increase your production, when you increase your scale of production, what do you mean by scale of production? Scale of production means you are increasing your all the inputs by same proportion. When you increase your all the inputs in the same proportion, only then we call it as change of scale in proportion, change of scale in production. So when I increase my scale of production, what happens over here is that first I'll encounter increasing returns to scale, then I will encounter constant returns to scale, and then I will encounter decreasing returns to scale. This is as per law of returns to scale, that when I increase my production, what happens? Initially I encounter increasing returns to scale. Even if I increase my inputs by some percentage, now my output increases by more percentage, my output increases by more than the increase in input. So that is why by less increase in the inputs, my output is increasing more. So that is why I am getting increasing returns, because my cost is decreasing initially, my returns will increase initially. So that is why initially I encounter increasing returns to scale, then I encounter constant returns to scale, and then finally after a point of output, if I keep on increasing my input, what will happen? After a point of time, I will start facing decreasing returns to scale. And what happens when my decreasing returns to scale happens? My returns are decreasing. When my returns will decrease? When my cost increases, my returns decreases. So that is why my LSC curve then increases after a point of time, after a level of output. Or you can also say that initially when you increase your production, initially you encounter economies of scale. What do you mean by economies of scale? That because of larger production, your per unit cost decreases because of larger production. So initially you encounter economies of scale, but after a point of time, if you keep on increasing your output, what will happen? After a point of time, you will start facing diseconomies of scale. And when you start facing diseconomies of scale, what happens? Your long run average cost curve starts increasing. So a question comes in the exam that the negative slope of the long run average cost curve. What do you mean by negative slope? The downward sloping slope. The negative slope means the downward sloping part. The negative slope part of the long run average cost curve is due to economies of scale. The positive sloping part of LSC curve, the upward sloping part of LSC curve is due to diseconomies of scale. Are you getting my point or not? This is the reason of the shape of why your LSC curve is U-shaped. Yes, next point is, my friends, scale of production. Now see, large scale of production leads to reduction in the cost of production. Now what people think, sir, see, if I'm increasing my production, how will my cost will decrease? Arey beta, what is happening? Your per unit cost is decreasing actually. Your per unit cost is decreasing. Please understand. Over here, what are we studying? We are studying average cost. दैट इज पर यूनिट का कितना कॉस्ट है, व्हाट इज द कॉस्ट ऑफ पर यूनिट, है ना. दिस इज नॉट द टोटल कॉस्ट कर्व, दिस इज नॉट द लॉन्ग रन एवरेज टोटल कॉस्ट कर्व, दिस इज नॉट द लॉन्ग रन टोटल कॉस्ट कर्व, दिस इज द लॉन्ग रन एवरेज कॉस्ट कर्व. So when I increase my production, my total cost increases. When I increase my production now, my total cost will increase, but my average cost will decrease. There is a difference between total cost and average cost. एवरेज में my cost decreases because of economies of scale, and average में my cost starts increasing due to diseconomies of scale. Are you getting? Because students think that, sir, I am increasing my production. I am increasing my production, my cost will increase now. Why it is decreasing over here? Average में it is decreasing, and average में it is increasing over here. Are you getting my point or not? Yes. So see, because of economies of scale, what happens? That your per unit cost, your average cost decreases, है ना. चलिए, so there are two types of economies. One is internal economies, other is external economies. What do you mean by internal economies? Now friends, under internal economies, what happens is, under internal economies, when a firm expand its own output, when I am increasing my own production, when I am increasing my own output, and because of increasing of my own output, my average cost is decreasing, that is called as internal economies. And what is external economies? When the whole industry expands, when the whole industry, for example, if I am a steel company, if the whole steel industry expands, and because of that I am getting an advantage on cost, because of the expansion of industry, my cost is also decreasing. Those economies would be called as external economies. So external economies are not dependent on output of individual firms. This can come as an MCQ, very conceptual point, that my external economies are not dependent on individual output, but my internal economies are dependent on my individual output. And if I increase my output, then I may get internal economies. Or if the whole industry expands, what will happen? I will get external economies. Okay, so I have taught this topic on Unacademy special class. I've taught this topic on Unacademy special class, so you can go there and watch that topic. I'll share the link of that video in the description box. Okay, or you can read this topic yourself also. It is not a very much difficult topic. Yes, so this is a bit less important. Okay, so there are 5 types of internal economies and diseconomies: technical, managerial, commercial, financial, risk bearing. And the last point is external economies. Cheaper raw materials, technology. External economies: development of skilled labor, growth of ancillary industries, better transportation, and economies of information. So if you have any doubt in this part, so this is a homework for you, because these are the less important part of this chapter. So you can read this yourself, and if you have any issues, you can always ask me. Yes, you can join our Telegram channel. What are my Telegram channels? Our Telegram channel's name is Just CA Foundation. So we have also started our channel. We have started opening our channel for a particular time. Yes, so for example, every day we open a Telegram channel for I guess 1 or 2 hours, in which 1 or 2 hours you can ask your doubts from all the faculties. So if you have any doubt regarding any concept of this chapter or any chapter of economics of BCK, you can always ask me in our group, in our official Telegram channel. The link of our official Telegram channel has been shared in the description box of this video. So you can definitely go and join that channel. And after joining that channel, whenever we open the chat over there, you can definitely ask your doubts over there. Okay, yes. So let's start with the quiz time. Let's go. The first question of quiz time is: the diminishing marginal returns implies option A, decreasing average variable cost, decreasing marginal cost, increasing marginal cost, or decreasing average fixed cost. So please write in the comment section that whether the answer is 1A, 1B, 1C, or 1D. Write it in the comment section. Yes, before the timer gets off. Okay, please write the answer. Please type the answer in the chat box. Yes, so what is the answer? The answer is option C. Now see, since your marginal returns are decreasing, it means that your marginal cost would be increasing. So because of increasing marginal cost, you get diminishing marginal returns. Next, the next question is, my friends, costs which have a direct relationship with a component of operation like a manufacturing of a product, organizing a process or an activity are called as option A private cost, option B outlay cost, option C opportunity cost, or option D traceable cost. What is the answer? Please write in the comment section 2A, 2B, 2C or 2D. Yes. Yes, guys. So the answer is option D, traceable cost or direct cost. Yes, traceable cost is also called as direct cost. Then next, my friends, what is the average fixed cost of 4 units of output? So using this data, you have to calculate that what is the average fixed cost of 4 units of output. Okay. Yes. Yes. So the next question is question number 3. The average fixed cost of 2 units of output is option A 80, option B 85, option C 120 or option D 135. So what is the average fixed cost of 2 units of output using this data? You have to use this data and answer the question. Okay. So 3A, 3B, 3C or 3D. Type in the chat box. Okay. Type in the chat box, the live chat box. Okay. Yes. So how do we solve this? We solve this like, now see, at 0 units of output you have some cost. This means that at 0 units of output we only have fixed cost. We have to incur only the fixed cost, which means that our total fixed cost over here is 240, and total fixed cost remains the same at every level of output. So when I'm calculating average fixed cost at 2 units, what will be the answer? 240 upon 2. So the answer will be 120. The answer is option C. The answer is option C. Okay. Next question, my friends, is next question. Which of the following is not a determinant of the firm's cost function? Which of the following is not the determinant of the firm's cost function? Yes, the production function, the price of labor, taxes, or the price of firm's output. What is the answer? 4A, 4B, 4C or 4D? Yes. Yes, friends. So the answer is option D, the price of firm's output. Array, what do you mean by this? The price of the firm's output means the selling price, at which you are selling your output. How will your cost depend on the selling price? Your selling price depends on the cost. Yes, obviously your firm's cost function does not depend on the selling price of your output. Okay. Yes, because first we calculate the cost and then we calculate selling price, है ना? So selling price comes afterwards. The cost function is not dependent on the selling price. Okay. So the answer is, which is not a determinant, option D is not a determinant of cost function. Next question is, my friends, Manish wrote the following sentences in his exams regarding short-term average costs. Which of the following statement is incorrect? ABC normally falls as output increases from 0 to normal capacity due to occurrence of increasing returns to variable factor. AFC curve, average fixed cost curve, will slope downwards throughout its length, but it will not touch the x-axis as AFC cannot be 0. When ABC curve begins to rise, but AFC curve still falls steeply, average total cost curve continues to fall. This is because during this stage, the fall in average fixed cost curve is greater than the rise in the average variable cost, or option D is none of the above are incorrect. So the answer of this question is, my friends, The answer is option D. The answer is option D. Yes. So obviously it is option D. All the three options are totally correct. Yes. So what is the answer? There are none of the above are incorrect. Okay. So Manish has written all the correct answer. Then last question for today. Last question for today. In the figure below, possible reason that why the average variable cost curve approaches the average total cost curve. Option A, fixed costs are falling while total costs are rising. Total costs are rising while average costs are also rising. Marginal costs are above average variable cost as output rises, or average fixed costs are falling as output rises. Yes. So see, the average total cost curve is average variable cost plus average fixed cost. Now, as your output is increasing, what will happen? Your the value of average fixed cost will keep on decreasing. The value of average fixed cost will keep on decreasing. Now, as your output is increasing, your value of average fixed cost is decreasing. That is why the difference between average total cost and average variable cost also decreases, because the difference between average total cost and average variable cost is of average fixed cost itself, and average fixed cost is decreasing by when output is increasing. Yes. So average fixed cost is, because average fixed cost is decreasing, that is why the difference between average total cost and average variable cost is decreasing as output increases, and that is why AFC curve approaches the average total cost curve. Why? Because average fixed cost curve, because average fixed costs are falling as output rises. So the answer is option D. Okay. Yes. So over here I complete my revision lecture of theory of cost also. So we have also completed the chapter 3 of economics, that is theory of production and cost. Thank you so much guys for watching all the English revision lectures. Please do subscribe to our YouTube channel, Just CA Foundation. We have just crossed 3K subscribers. We have also crossed 3K subscribers. So thank you so much for that. Please like and share our videos with all your friends and press the bell icon. And I am taking the course of economics chapter 4 and 5 on the plus, on Unacademy plus. So if you want to study the whole course of economics and BCK from me, so I've already given you the revision videos of BCK chapter 1, 2, 3, and I've already given you the revision videos of economics chapter 1, 2 and 3. So if you want to study other chapters from me or from other educators on the Unacademy plus, so there are many educators who upload videos on the Unacademy platform for various subjects. So if you want to study even other subjects on the Unacademy platform, so you can subscribe to Unacademy plus, and while you subscribe to Unacademy plus, you should use the code MVSIR to get a 10% off on your subscription. Yes. And I am daily conducting many MCQ quizzes on the Unacademy app. Daily I am coming and conducting on MCQ classes on the Unacademy app. I had also conducted a session on the Diwali also. Yes, I had also conducted a session on Diwali. Yes. So every day I am coming every day for the MCQ classes. So do join me in the MCQ classes also. I daily share the link. Of my classes in our official Telegram channel of Just CA Foundation. So the name of the official Telegram channel is Just CA Foundation itself, Just CA Foundation. The link of this Telegram channel has been shared in the description box of this video. So do join the Telegram channel also. And thank you so much. Thank you again. I wish you all a very best, all the very best of luck for your exams, and we'll meet after you clear your CA Foundation exams. Okay. Thank you so much. Bye bye.